The global AI healthcare market is racing toward $110 billion by 2030. And wound care alone? That's already a $22 billion market today, expected to hit $30 billion by 2029. But here's what almost nobody is talking about. A $50 million NASDAQ-listed company just locked in a $149 million contract with BARDA, part of the U.S. Department of Health and Human Services. This deal validates AI technology that could revolutionize wound healing prediction for both military and civilian medicine. And it gets even more strategic. They're also developing portable, battlefield-ready wound assessment technology under a separate $1.1 million Defense Health Agency contract. That makes this a dual-threat play, tackling military medical preparedness and America's diabetes crisis, which affects 8 million patients with chronic wounds. Here's the kicker. This breakthrough has flown completely under the radar. While the media obsesses over ChatGPT and trillion-dollar AI hype stocks, this medical AI pioneer is trading at just $1.60 near its 52-week low. And with an FDA breakthrough device under review, clearance could come any month now. Sound familiar? Back in September 2023, when they announced the $149 million BARDA contract, this stock rallied to over $14. Now, with FDA de novo submission completed in June 2025 and commercial launch targeted for late 2026, we're at another major inflection point, just before institutional investors pile in. The question is, will you spot this regulatory catalyst while it's still mispriced, or watch from the sidelines again? Let's break down why this might be the most undervalued AI diagnostic play on the NASDAQ right now. All right, cards on the table. We're analyzing Spectral AI, ticker MDAI, NASDAQ listed. Trading near $1.60. Yes, it's a small cap stock with about 31 million shares outstanding and a market cap around $50 million. But the technology behind it isn't small cap science. This is a precision diagnostics play with real regulatory progress, real clinical validation, and real government contracts. Spectral AI's core product is DeepView, an AI-powered medical imaging system that predicts wound healing outcomes, specifically for burn patients and chronic wounds. Instead of waiting weeks to see if a wound heals, doctors get predictive analytics within hours. This isn't just faster diagnosis, it's decision support that can prevent unnecessary surgeries, reduce hospital stays, and save limbs. And preventing one amputation saves the system hundreds of thousands of dollars. That's the value proposition hospitals and the Department of Defense are investing in. Let's get into the financial reality, because that's where the thesis either holds or falls apart. Spectral AI reported approximately $30 million in revenue for full year 2024, a 64% increase from the prior year. The current market cap sits around $50 million. That means the stock trades at roughly 1.7 times trailing revenue, compressed compared to most early-stage medtech companies. But here's the context. That revenue isn't from product sales yet. It's primarily from their BARDA contract. Government funding for developing the technology. For 2025, management initially guided revenue around $21.5 million, but revised it down to approximately $18.5 million due to government contract timing. That's a revenue step back, but not a failure. It's the transition phase between R&D funding and commercial launch. Because Spectral AI submitted their de novo FDA application in June 2025. FDA review typically takes 6 to 12 months. If clearance comes through in the first half of 2026, the company expects to begin generating commercial revenue in the second half. That's when the business model transforms. Recent quarters show this pattern. Q1 2025 delivered $6.7 million in revenue. Q2 was $5.1 million. Q3 dropped to $3.8 million, bringing year-to-date revenue through September to $15.6 million. The sequential decline isn't collapse, it's contract timing. BARDA work phases in and out based on development milestones. Now, Cash position matters. As of Q3/20/25, Spectral AI had $10.5 million in cash. In October 2025, they raised an additional $7.6 million through equity financing, extending their runway into 2026. They also have access to a $15 million debt facility from Avenue Capital, with $8.5 million drawn as of Q1 2025. That's non-dilutive capital, which matters for shareholders. Now, valuation becomes interesting. At current revenue run rates, the stock trades at roughly 2.8 times forward 2025 revenue. But if FDA clearance hits and commercial sales begin ramping in late 2026, conservative hospital adoption could push revenue toward $30 million to $40 million annually. At that scale, the current $50 million market cap represents 1.25 times to 1.7 times forward revenue, deeply discounted for a cleared medical device with government validation. Let's compare this to peers. Companies like NanoString and Inspire Medical trade at revenue multiples between 2 times and 8 times. Spectral AI is earlier, riskier, but has FDA breakthrough device designation granted in 2018 and a validated BARDA contract totaling over $54 million since inception. Analyst coverage is thin, but the few tracking MDAI have price targets ranging from $3 to $7.45. The consensus average sits around $4.33 to $5, representing roughly 170% to 210% upside from current levels. These aren't guarantees. They're models built on assumptions about FDA clearance timing and hospital adoption. To help you think through outcomes, here are 3 scenarios. Pessimistic, $1 to $1.30. This assumes FDA clearance gets delayed into late 2026, commercial traction stalls, and cash burn forces dilutive financing. Base case, $3.50 to $5. This assumes FDA clearance arrives mid-2026. Hospital rollout begins in Q3 to Q4, and revenue scales toward $25 million to $35 million by end of 2026. Optimistic, $6 to $8. This assumes FDA clearance comes early. The VA or DoD adopts DeepView as standard protocol, and revenue exceeds $50 million. Now let's talk about what can go wrong, because ignoring risks destroys portfolios. Spectral AI is burning cash. They reported a net loss of approximately $15.3 million in 2024. Growth depends on continued capital raises, which could dilute your ownership significantly. If they can't convert FDA clearance into hospital contracts quickly, cash runway shortens, and the next financing could come at punishing terms. There's execution risk. DeepView must prove its clinical value translates to hospital purchasing decisions, not just research validation. Reimbursement risk is real. Even with FDA clearance, getting Medicare and private insurers to reimburse can take 12 to 24 months, and because MDAI is thinly traded, volatility is extreme. A single headline can move the stock 15% to 30% in a session. So here's the mental frame. This is a binary outcome investment. Either the FDA clears the device and hospitals adopt it, or delays and cash constraints force a reset. Now make this personal. Imagine 2 investors 5 years from now. One says, "I saw the wound care AI trend but waited for certainty." The other says, "I understood the regulatory pathway early and held through volatility." Which investor captured the asymmetric return? That's the distinction between timing and speculation from a thematic standpoint. Spectral AI connects to several trends: AI-powered clinical diagnostics, point-of-care decision support, value-based care, military medical infrastructure. If you own healthcare names like Intuitive Surgical or Exact Sciences, you have exposure to established diagnostic infrastructure. Spectral AI is the high-risk complement, a way to play AI diagnostics before institutional adoption, but it shouldn't dominate your portfolio. Position sizing matters. Asymmetric bets work only when you can afford to be wrong. If you want more breakdowns like this, smash that like button, subscribe, and turn on notifications. Next up, we're dissecting another undercovered opportunity. Completely different mechanism, but built on the same principle. Stay disciplined, stay informed, and remember, the best investors don't chase momentum. They identify regulatory catalysts while they're still mispriced.